Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. On this snowy Tuesday, February 13th, a day after the Rangers took care of the Calgary Flames last night at the world's most famous arena, workmanlike fashion, a 2-0 shutout, empty net goal by Jimmy Vesey, as you know, Dan, late. Igor Shesterkin back in form. The Knicks get robbed in Houston. We'll talk about that later. But this is Market Call, 1 o'clock on the East Coast. How are you, Dan?
I'm doing okay here, Guy. It is a little snowy. It's not like the most exciting bit of snow. If you saw all the flurries as I did for my 12th floor apartment, you'd say, okay, maybe this thing is going to be packing it in a little bit, Guy, but it's not. It's just a bit slushy out there. So it is what it is. You know, I just got done recording OK Computer with Deirdre Bosa. She is the fine host of CNBC's Tech Check. I don't know what we're doing today. What are we doing today, Guy? What's the focus here? I see a sea of red on my FactSet screen, my main board here. I'm looking at it, and I have like hundreds of stocks on my main board, and I probably see 10 that are green on the day. So what's going on? Give me the rundown.
Well, what's going on is, as you know, and I'm sure our viewers and listeners know, that CPI print came in on the warm side of things. Some would call it hot. I would be one of those people. And the whole narrative of Fed being able to cut rates in March, I think that's sort of gone by the wayside. Yeah. I think June, which is the next meeting, I believe, that now is down to, I want to say, a 40 or maybe a 55, 60% chance that you have it there if you want to throw it up. But what's really interesting is there's actually now a market. There's a 7% chance, at least last I looked, for a Fed rate hike.
Whoa.
Which I think is pretty. And now, again, I'm not suggesting that's going to happen. I just want to be crystal clear. But, you know, given what we saw today, that's out there now. And I think yesterday we talked about vol being surprisingly bid on a pretty benign day. We said, don't make a big deal of it, but it's something to keep an eye on. You know, we've been talking about yields for a while, and we'll go right to it. I mean, 10-year yields, which were 3.8% a couple weeks ago, touched, I think, 430, if not just shade below 430 today, around 429 and change. So that's interesting as well. So there's just so many things to be concerned about. I've said for a while, I know you've backed me up on this. I don't think the market fully comprehends how persistent and pesky inflation has been and will continue to be. That's it in a nutshell.
Yeah. All right. Well, I mean, if you want to flash it up there, so we're going to focus on that CPI print. Maybe we'll get, kind of in some of the nitty gritty of that. I think this rate move is obviously really important. And just to your point, Guy, the expectation all of a sudden that there's even a, like a high single digit percentage chance of a hike would say that, market participants are now saying, okay, what would happen if we start to see inflation kind of tick up a little bit, right? And so to me, I think that is kind of interesting. If you just think back to just 2 months ago, right, when the S&P was raging, making new highs every day. I think last week with Friday's close, it was the 15th straight week of gains week over week, which is like the longest period ever. And a lot of that was predicated on the excitement by lots of market participants that the Fed was going to be able to lower interest rates, right? And so, also, listen, to be very fair, I think the excitement that the economy, performed much better than many people expected in 2023 heading into that year, right? And so, I don't know, man, it just feels like that a lot of people are off sides. And to me, the one thing that really hasn't kind of reacted to this realization that rates aren't probably going down too low anytime soon is the stock market, right? So let's pull up the S&P 500 here for a second, the futures, because this is one where, look at that, man. It was up like 20-some%. You see the steepness of that uptrend. You see how far away it is from that 200-day moving average. We had a conversation with Carter yesterday, Guy, and I think it was Peter Bookvar who sent this, and I think it was Doug Cass who highlighted it on his note on Real Money, that the highs in July when the S&P was up there, it was basically 11% above its 200-day moving average. That's where we were yesterday. And subsequently, we had a S&P 500 that declined about 11 or 12% over the next couple of months or so. So, for those of those folks who think that the S&P is the only game in town when we still have rates high, we still have an alternative, right, to equity returns. We still have expectations for an economy that's continuing to chug along. At some point, the S&P 500 trading at 24 times trailing and 21 times forward or whatever does not make a lot of sense in this kind of new rate regime, Guy.
No, listen, absolutely. And again, that's based on earnings expectations. And, I still think it's going to be difficult to match the expectations that the market has. We'll see. But, for some reason, I'm predisposed to dislike this guy. I think maybe because he covers the Fed and he seems to be a bit of a sycophant for them. But let's throw up this quote from Nick Timiraos, who took over the helm from that. What was that other short guy's name that I forget? He used to come on all the time. They're both probably really short because, if you can't be an athlete, cover the Fed. Anyway, what CPI means for the Fed, rate cut ruled out, even more so now. I think we all agree with that. But, it's some of the things underneath that are problematic for people, and insurance costs through the roof. Obviously, rent, or just however you want to view housing, or having a roof over your head, through the roof. Medical costs all the things that are problematic have been problematic for quite some time. So people will point to gasoline coming down over the last year. It has. The problem, of course, is some of the main other culprits have not, and actually starting to reaccelerate higher.
Yeah, no, it's
Hell's and Wrath, right? Hell's and Wrath. That's the one.
Yeah, no, I think those guys are probably butting up against
yeah. Well, I don't like either one of them. So
hey, listen, you know what, Guy? There's a chance they were just assigned the Fed, okay? And maybe
could be
just doing their thing. You know what I mean?
That's fine.
So,
I mean, it's all good. I mean,
it's all good.
I'm just letting people. Me. I'll put it out there. For whatever reason, I don't like either one of them. But back to you.
All right, let's go to the CME Fed tracker here, Guy, looking out to May, because as the March, expectations for a cut got pushed out, here we are looking at May. And to your point, it's not a slam dunk there. We're hearing some stuff, as you just mentioned from that tweet, that's looking like maybe July. And it's interesting that the stock market in 2023, okay, the more that the cuts got priced into the market is the higher the stock market went, right? So now the further out the cuts are being pushed, the stock market is down 1% from the all-time highs it was making yesterday. So the one concern that I have is that at some point there's going to be some sort of something that ignites a flame, Guy. You know what I mean? And maybe it's NVIDIA's earnings next Wednesday. I don't know if you caught this. There's an article in the Wall Street Journal this morning, and we were talking about this on some of our pods. It was about Microsoft Copilot. Okay, Microsoft Copilot is this. Basically, they're using ChatGPT, OpenAI's technology that they've spent $13 billion as Microsoft and getting access to over the last, call it, couple years or so. And they're going to integrate this, okay, into all of their Office 365 tools, right? And it's supposed to be this thing that's going to revolutionize workflows and make you more productive. And there was this great Super Bowl ad about this, is kind of humanizing it, right? Not something you should be afraid of. And the reviews were pretty lukewarm, and I've been using ChatGPT 4, the one that I paid $20 a month for, and I'm kind of underwhelmed. I'm never going to use Bing search. Okay. Don't use Microsoft 365. I don't use any of their products. So I'm not going to use Copilot. Right. And so the fact of the matter is that review is out there from people who use Microsoft products, and it's not particularly great. The issue that I have is that Microsoft has gained $1 trillion in market cap over the last 4 months, as people have gotten really excited about the prospects of this adding considerable revenue and profits to a company because they're able to charge more for this device. So
that's exactly right.
If people start pricing in the fact that maybe it's not going to be the thing that they thought it was going to be 4 months ago, what happens to Microsoft, Guy?
Right. They're assuming the things that people want or the market needs. And, maybe it is at some point. I just think that we're, really far ahead of ourselves in terms of the timeline. And, you asked what could be sort of the match. Pull up a chart of ARM Holdings, ARM, and we talked about this yesterday. You know, we talked about the gap higher that we saw yesterday. We talked about the price action. Doug Cass sent us a tweet or an email as well to talk about it. You had this gap open higher. I think if we can do maybe a longer term chart, you'll see exactly what I'm talking about. On huge volume yesterday, you had a gap open higher. Well, guess what happened today? You had a gap open lower. So there's a very good chance you've created this sort of a bit of an island reversal here in this name. So what could go wrong? Well, if this is in fact the technical setup that I think it is, and then you have NVIDIA coming up, you have interest rates going higher. What's that term that I use, Dan, all the time? A what?
Bookmark, footnote.
Which is brew. So you haven't used it in a while, so you forgot.
You haven't used that in a while.
But hey, that is, by the way, a witch's brew.
By the way, I caught this because I was not involved in this conversation, but on our Fridays on the Tape podcast that dropped, you and Danny Moses interviewed a guy named Luke Roman, and he used the expression, Katie bar the door. Did you get all excited about that?
Well, absolutely. That's another G Swizz favorite. So no question about it. Look, that, you know, again, and I'm not throwing this out. Just Japanese stock market's done extraordinarily well. I mean, we can talk, but again, dollar yen, which was a concern of ours for a long time, when it was north of 150 a few months ago, subsequently saw it go from 151 ish down to 140. We've gotten all the way back north of 150 again. That's something that nobody's talking about. I promise you, if that continues, if the dollar continues to strengthen against the yen, people will start talking about it ad infinitum, number one. So just keep an eye on that. Dollar strength is a problem. That's been a wrecking ball. That continues to move. We're going to talk about gold in a second. You know, I think I understand why gold is selling off today. I don't necessarily agree with the thought process behind it. We'll see how that plays out. But, you know, the technical setups in some of these things are a little alarming, I think, Dan.
Yeah, and it's not just the technicals. I guess the other point, and we spend a lot of time talking about sentiment. We talk about expectations, right? And so, you know, I made this point the other day, and I think it's just really important. You know, a lot of people want to dunk on, I'll just say me or any pundit when they're wrong about like something. And NVIDIA is a clear one that a lot of folks remember that I was kind of poo-pooing and obviously really wrong last year. Not the technology, not their positioning in the space, not this, just kind of, you know, like the excitement in and around it and what it might mean for this ecosystem and the secular shift or whatever. And I clearly got that wrong on a few occasions last year. Okay. But this year on January 5th, and it was largely about technicals. It was largely about relative underperformance, you know, and we detailed it on Market Call. I did it on CNBC's Fast Money. The stock NVIDIA was at 490. And I said, this stock's going to break out. And it's going to break out in a big way. And once, and you know, the NASDAQ, let's pull up the NASDAQ chart for a second here. And the NASDAQ had sold off a little bit. All the Mag 7 were down. Do you remember that the first week of the year? And I said, when the NASDAQ gets back on its horse and it finds its footing, NVIDIA will actually, look at that, will massively outperform, which it has this year. So if you think about NVIDIA, it's up 46%. Not in a million years did I think it was going to go up 46% in a month, okay? But I did think it was going to outperform the NASDAQ probably 2-to-1 or 3-to-1 or something like that. So if the NASDAQ had rallied 3%, maybe it was going to be up 8 or 9% or something like that. So I didn't get it wrong this year. Now, I haven't been a buyer of the stock, but the point I want to make, Guy, is that now let's pull up Tesla for a second. Okay, we've been talking about the unusual sentiment. We've been talking about the degrading fundamentals. We've been talking about the macro environment, how it's not actually particularly great. We've been talking about some stuff, you know, relative to Elon and stuff like that. But look what's happened over the last year. So, you know, what did your football coach used to say to you about being early?
If you're early, you're on time. If you're on time, you're late. And if you're late, don't bother.
Yeah, and it doesn't really work being too early in the stock market, right? When you're kind of, you know, being a little bit contrarian. But this one, after that huge ramp, you know what I mean? Like that we saw last spring. This has been a sell every rally sort of thing. And when the company has actually turned the mics on and given the prior quarter's deliveries and results, the stock is gapped down 10% on average over the last 4 quarters. And this thing is going lower. The fundamentals, they suck right now, and they're not getting better anytime soon. So now let's flash up NVIDIA. Okay. So coming into this year, the stock grew into the valuation, Guy, and it was cheap. but up 50% from its lows in January, gaining nearly $900 billion in market cap, it's no longer cheap. And now for it to grow into that valuation, it's got to go considerably higher. You know what I mean? And the results have to be considerably better. And that's just not going to happen from here, guy.
We mentioned, yesterday we talked about Sun Microsystems and some of the math around that was required for that stock to continue to perform the way it did. And, I think NVIDIA, the revenue next year, expected revenue, I'm going to round up, is about $100 billion, which, a considerable growth over the last few years without question. But when you're talking about a company that just was trading 1.8 trillion, I mean, I can do that math. It's trading 18 times sales, which is in that world historically rich. By the way, it's been richer than that as well. So in order for it to be at a reasonable valuation to sales, that 100 billion number, in my opinion, should be closer to 250 billion. Now, people will say, Guy, that's fine. They're going to grow into that. Okay. If that's the case, I understand why people are buying the stock here. But let's say that's not the case, right? And you start to see revenue start to taper off and you don't have nearly the growth rate you've seen. Then all of a sudden, that price to sales, which people are seemingly not looking at right now, everybody's going to be laser focused on.
All right, but this goes back to the fundamentals, and this is just not about NVIDIA. It's just how we look at these things and why we can be early and why I was early on this one, because it clearly did grow into its valuations. Analysts did not take their estimates up enough, okay, for like the full out year. You know what I mean? They were doing it quarter to quarter. And so I guess my point, Guy, is that what was unique about NVIDIA last year is that they literally had 90% of the market share of high-end graphics chips that were used to train these models, that were going into these servers, that were going into the data centers, and there was not enough supply of them. And they had only supply. They also had the Chinese competing for the, so they were like, they totally screwed up the demand picture in front of what was going to be bans of high-end chips, right? So then everybody and their mother is trying to compete with this. AMD's been like they were trying to get in the space. So now the competition's in, the supply demand, relationship is going to improve a little bit. Maybe if you have more reviews, like we heard about Copilot this morning, okay, that there's maybe not going to be such great demand. Maybe as these companies go from the training phase of these models to what they call the inference phase, maybe that's less data intensive and there'll be less need for GPU. I mean, the list goes on and on. Like, their customers, the hyperscalers, okay, the biggest customers, the concentration here, I think it's Microsoft and Meta are like 30% of their revenues, okay? Throw in Alphabet and Amazon, and you get to like 45% or something like that. So let's just say they don't commercialize these products. They stop buying these things. They're designing their own ones, right? To obviously have cheaper price points. The competition's coming and they're going to compete on price. Okay. So when you think about next week, and we'll spend a lot of time on it, it just has the potential to decelerate. And if you disappoint after moves like this, I mean, you tell me what happens, Guy.
Yeah, listen, I wanted to point out the ARM Holdings chart because you could very well see similar. And the fact that I thought ARM was interesting was not only the price action, but the amount of volume that the stock traded, which suggests a little euphoria yesterday without question. I mean, I think yesterday it traded close to 15 times normal volume. So let's see how it plays out. I feel the same way NVIDIA, and that futures chart, we just looked at the E-mini in terms of the Qs, the E-mini in terms of the S&P. There's hauntingly similar charts. So we'll see if this support level that we have drawn holds. It's holding for now, but there was a chart that a tweet that CQ put out there earlier. Again, Marko Kolanovic from JP Morgan, who really has not changed his tune. I think he's been somewhat cautious now for quite some time. But he put a tweet out sort of talking about the divergences he's seeing between some of the markets. And, that continues to happen. It's interesting how euphoric people are on the one side of the coin here in the United States. He didn't mention China. He mentioned Europe. But flip side is that's how negative people are in China. And I think probably have record short positions. So there's so many things out there that are just flashing red right now, Dan.
Yeah, the last point I want to make about, like, maybe we can throw up Marco's tweet, or it's actually from Carl Quintanilla. You know, a lot of people have enjoyed dunking on Marco, who we've known him for a very long time. Really smart guy, very thoughtful guy. It's one thing to be a strategist and just be wrong and dig in, but you know, if you read these guys, like this is the most important point. We made this on the tape a week or two ago about Mike Wilson, who you and I have a ton of respect for, and have known a very long time. If you read their work, if you talk to them, and you don't just read a tweet, or you don't just read someone else's interpretation of this dogma that you think is going on, or this and whatever, like they will help you make your own mind up about the market, about macro inputs, about sectors, about individual stories, about timing. I mean, the list goes on and on. And so this whole notion that you can just dunk on these folks because, you know, they're not like flapping in the wind like most of the other strategists, like most of the other pundits out there, like to me, that's a freaking joke. Okay. So like do your work, read what these people are saying, even if you don't agree with their target or the S&P or where you think the market's going over the next 3 months. I guarantee their work will be helpful to you. You know, I'm seeming a little ranty here, but a little fired up. I think we're on the precipice of something here, Guy. In the market. I want to pull up the small caps for a second because
Yep,
this
I
is
was just going to say, look at the E Russell's, the futures. We can throw up an IWM chart as well, but this is a futures day, so let's take a look.
Yeah. I mean, look at this thing. I mean, like, so we highlighted the fact yesterday that it had 2 consecutive, you know, up, you know, days that were maybe 3.5%. To have the Russell down, Guy, 3% like this, doubling up the Nasdaq's down 1.5% or so. Like that's really important. And you've talked about this on many occasions over the last 18 months with the Russell. There's few better indicators about like when it comes to failed breakouts other than the Russell 2000, because it seems like the Johnny come latelys, they get to this one last. And so when they bust out and then fails, you almost want to be like, you know, watch out below for the S&P and the Nasdaq.
Yeah, that's the channel. I mean, or whatever you want to call that. I mean, that's the range we've been in, and we've pointed out a number of times. This is obviously the E-mini Russell 2000. I mean, we could look at the IWM. It's going to look exactly the same, so there's no reason to do it. But with that said, you know, we're at the upper end of that channel and seemingly failed once again. And I do think that you're probably going to make a push in terms of the IWM down to 185 or so. And the ultimate goal could be down in the 160s or so, which we saw over the last summer and into October. So I think that continues. I'm hard pressed to believe, this is again just me, you know, if inflation is as sticky as I think, it's going to really hamstring these small and medium sized businesses that find themselves in either the E-mini 2000 Russell futures or the IWM or whatever else you want to look at. So just keep an eye on this because I think it definitely tells a story.
Yeah, and this is important. So the Russell, you know, like we can spend as much time as we want on the S&P and the Nasdaq. We know that, you know, a handful of names are driving the performance, but I think, you know, keeping an eye on this one and the relative performance to the larger cap indexes is important. Another sector, Guy, that I think you and I are both really focused on, especially with this rate move, okay, is the banks. And so we spent a bunch of time with Carter over the last few weeks on the regionals, but let's pull up the BKX here because this is one that's kind of interesting to me. Okay. We had that breakout, you know, in December. We've been really going sideways. You know, the banks were kind of the first sector to report that move in December, that 2-day move that you see right above that kind of prior high, that was in and around that mid-December Fed meeting, right? And so a lot of people were really focused. They thought that was a really dovish sort of term, but look at that. It just went sideways, right? And the bank earnings weren't particularly great. So if you were excited about banks because yields were coming down and the big money centers that had these mark-to-market losses, right, and these held-to-maturity books, if that was going to alleviate some of that. Well, with rates going back higher, it should be the opposite. So you see the lines that we've drawn, the uptrend from the October low, that breakout level, which has now been support, and you see where the 200-day moving average is, Guy. Like, this is an important chart to me.
I agree. And if you look at the lows made sense, I remember discussing this back in the fall. As you know, the May low, I think in the BKX was about 71 and change. We obviously had a huge rally on the back of the Fed coming in, Silicon Valley Bank, First Republic, blah, blah, blah. You saw the base go from 71 to 90. And then you saw a revisiting of that 71 level in October and November. We held, double bottom, bounced. You saw what the bounce is. If you extend this chart out, you'll see that we traded up to, so resistance has become what past support was if you go back a couple of years. So current resistance was past support,
Yep.
and here we are sort of trading sideways. If yields are going to go higher from here, which I do think is going to continue to happen, these are going to be under pressure. And I think that sort of 84 level or so, which is the moving average, comes into play. So you've had a heroic run on the back of, again, rates moving in your direction, lack of negative news. But here we are going sideways, and I think we're sort of setting up for a move lower.
Yeah, and I just want to highlight JP Morgan for a second here. So obviously best of breed, people, that's where they're going to crowd into, right? And we know that Bank of America was one of the ones really, heavily exposed to, buying treasuries, a couple years ago or a few years ago during the pandemic when they were yielding nothing, right? So that was a big problem on their balance sheet. Let's pull up JP Morgan for a second here, because why is this important? It'll be the last battle fought, in my opinion, among the banks. You could have drawn an uptrend from the October lows. We're breaking that a little bit. You see that we're sitting on support there. Look at that. These guys are good. You see that guy? You see how quick that. So that 160 level was the breakout level just a couple months ago. You see that 200-day moving average all the way down there at 150. Guy, when's the last time you've seen JP Morgan, okay, like, $20 or plus above its 200-day moving average on a percentage basis? You can do that math. It's over 10%. We know the S&P is over 10%. It just seems like things have gotten a little out of whack. So again, sometimes it makes sense to watch the best of breed. We can all get hunkered down watching the worst ones, the ones that'll be most heavily affected by a move in rates or something like that. But let's see how the best one acts too.
It's interesting. I mean, I'm comparing them only because, they live in the same universe. JP Morgan, I think just recently traded at an all-time high, or within, a dollar or so of it. The Bank of America, the all-time high was in the fall of 2006, if I'm not mistaken, if you want to go back and look. And obviously that stock is nowhere near that. So as well as JP Morgan's done, quite frankly, because they are the best bank out there, and Jamie Dimon tells a great story, you think about some of the damage on some of these other banks that we seemingly gloss over every once in a while. And, in a lot of ways, and this is going to sound ridiculous, I mean, a lot of these banks really have yet to recover from 08, 09. I mean, they've been treading water for quite some time now, but, haven't had a significant recovery from those periods of time as in the opposition of like a JP Morgan. So just something to keep in mind as we move further into the year.
Yeah, no doubt about it. And again, I think a lot of it has to do with the fact that they've just, the regulation and what these banks look like. And it's just like they're kind of utilities in a way. They don't have the sort of leverage to like a rip-roaring economy that they might have done because the risk that they were willing to take in periods prior. Let's talk about crude oil here. We spent, a little time talking about inflation, talking about gas at the pump and the like. And last week on Tuesday, you and I were talking about crude oil. We're looking at the futures here. Jacob's got a clip for us just to kind of recap what we're thinking. I think both of us thought the technical setup looked pretty decent, playing for a move higher back towards the prior highs in the upper 70s, maybe as high as 80 or so. So let's look at that, and then let's kind of update our view on crude oil a little bit. If you're inclined to take a shot on crude, that uptrend, right, from the December lows is really important. And why do we kind of keep thinking about it with the idea of using a stop down there if you're inclined to play for, a move back towards that moving average, back towards that recent high that got up there towards 80? To me, I think if you want to take a crack here, like you on the long side, what's your stop? Maybe 72.5 or something like that. You don't really want it to break below that uptrend, because if it breaks below that uptrend, you're going back to 70, which is that recent low in January. And then the December low is somewhere like $68.
That's right. I mean, it's playing out. So let's pull up a chart today because, we outlined the levels for you. Dan did a good job there, obviously, and you see where we're trading now. So, that what we traded down to, if you think about that downtrend that was broken. So we broke this downtrend line. We traded through it, traded up, traded back down, and tested it, which was in correlation to an uptrend line that we drew, and then we bounced off it. We're at the moving average. There are a lot of strange things happening here. So a lot of people say, what, guy, we traded here before, we're going to fail. That's fine. I get it. And if you got in on a long position on the futures, maybe this is the time to pull the ripcord. I think there's more going on here. And, I think with all the geopolitical stuff that seemingly people want to forget about for whatever reason, that has not gone away. I think crude oil is still in play. And you heard from some of the OPEC ministers talking about supply demand imbalances. I mean, the fundamentals still suggest, in my opinion, that crude's going to go higher, especially if the headwind of a China that's been deteriorating is somewhat assuaged by the amount of money they're throwing at the system. So we'll see how it plays out.
Yeah, and the one thing I would say about this is that, again, I don't think either one of us were kind of pounding the table. We just thought the technical setup looked pretty good. We thought investor sentiment was like kind of complacent given all of what you just said there, guys. So we had the move. We're above that 200-day moving average. I have it as about 77.40, guy, and I'm looking at it at 78.18 right now. We see that prior high from late January, which was about, I don't know, just a little bit of high, 79-ish or 79 and a quarter or so. So what I want to do here is if you were long at 73.5 and use a 72.5 stop to the downside, I think it makes sense to move that stop up, right? And maybe it makes sense to put it in and around that 200-day moving average. That should be support. So you don't want to put the stop just above the 200-day moving average. You want to put it a little below that 200-day moving average if that is what you see as a good support level. And then you try to keep moving that stop higher, locking in the gains that you have. Does that make sense to trade crude this way, guy? And if you keep raising that stop, then you get the breakout possibly.
That's exactly right. At a certain point, if, with trailing stops, if you keep, in this case, when you're long, you're raising your existing stop. At a certain point, you're going to get stopped out, which is fine. I think we all understand. It's like being at a craps table and you throw a bunch of different winning numbers and the numbers keep coming up. At a certain point, you're going to have 7 out, but the leverage created up until that point is basically what you're looking for. The same way here. If you keep raising your stop, if the price keeps going higher, you keep raising that stop. It's just a matter of time before you get a day or two that's going to get a back and fill and you're going to get stopped out. But that's okay because that's how you play the leverage game. So quite frankly, you can add to a long position here and raise that stop and continue to play it that way if you want. There are a number of different things to do without question, but we just wanted to sort of highlight the technicals and how you basically trade futures on the back of it.
Yeah, let's look at the dollar. You just mentioned it earlier in the program here, Guy. What a heck of a move just today. And I know a lot of people are saying, if you're looking at the Dixie, the US dollar index, and you're saying, well, up 70 cents is not that heck of in a currency, cross like this, that is a big move. You see the move off of those late December lows below 101. And when we kind of tie this back together, corporate earnings and how it tracks with rates and the like here, this is a tough setup, in my opinion, for stocks. Again, I am surprised with yields is up as much as they are today. Okay, I'm seeing up, 10, 11 basis points in the 10-year, and the dollar up like this. That the S&P, it's down now by like 1.3% or something like that. It has the potential, in my opinion, to really start to snowball a little bit. And you see that channel that you've drawn there, Guy. I mean, if we kind of continue to get to the upper bounds of that, there might be some resistance there, but I just don't see the stock market. I don't see the S&P hanging in around 49.50 if the dollar and rates continue to go higher.
Yeah, well, the tailwind of a weakening dollar since the fall has obviously changed course considerably. And now we've basically gotten halfway back from, you can go back and look, sort of the October, November highs in the dollar to the recent lows we saw earlier this year or late last year. So 50% retracement, maybe this is a logical place to stop, especially if you look at that channel. It all makes sense. But I'll just say this about a stronger dollar. I mean, historically, a stronger dollar does damage to multinationals. It's typically a pretty big headwind for earnings, and I don't think enough people are talking about that. So what was a tailwind for earnings and the backdrop was good for months into this year is now changing on a dime. And again, I don't think market participants, to your point, are taking that into consideration.
Right. And so on the other side of the strong dollar, Guy, is weak gold here. And it's one that, we've been tracking, for months and months here. It's, held up relatively well in this dollar move, right, over the last, call it 5 or 6 weeks until today. So help our viewer, help our listener think about this sort of move in gold and how maybe this is a bit of a knee jerk on a CPI day that has actually gone the opposite way that a lot of people might have been expecting. Guy, a lot of the previews that you and I were reading into this morning's print was like, we're going to be the first one with a 2 handle in 18 months, whatever the hell it is, right? Or in a very long time. And it didn't go that way. And if it starts to go the opposite way, where 3-1 becomes 3-2 or something like that, then that just pushes out these rate cuts further. It could mean that we have higher dollar, higher yields. And does that exactly have to mean lower gold?
Yeah, that's really interesting, right? So now you have this reemerge. I don't want to be too hyperbolic, but okay, a resurgence of inflation problems, right? And obviously, you would think that'd be bullish for gold. But what the market says is, well, wait a second. If the Fed sees this, obviously they're not going to cut rates, and they're going to do what they can to combat that. So those rate cuts are being pushed out. Obviously, that's bullish for the dollar, bearish for gold. It's pretty one-dimensional, and I totally understand that. But if you start to dig around a little bit, I mean, you see the buying that continues to go on by central banks. You see what's going on in terms of all these different countries, in terms of the fiat currencies around them. All roads lead to gold. So one day action makes a whole hell of a lot of sense. But it's going to be, I think could be a point where yields go higher, dollar goes higher, and actually gold starts to go higher as well. We're obviously not there today, but that's an outcome that I don't think is necessarily unfeasible.
Yeah, and I'll just say from a technical standpoint, Guy, I think the lower end of that range that gets you to that kind of that mid-December sort of period, like it's 1990 or something like that, or so, or we're 1990 here, so it's just a little bit lower. We're approaching the 100-day moving average. I see the 200, which is really flatlined. It's also kind of that breakout level too. So, we'll check back on this one, because I think if we were to continue to see rates go higher, equities go lower, and the dollar go higher, this thing probably has a little more downside. Let's see if it finds support at that green and yellow line. Does that make some sense to you?
I mean, no, it makes a lot of sense to me. Obviously, I'm watching it. I understand, again, today's action makes sense. The action in a lot of things today makes sense without question. The reality is, or what's going to be really fascinating to see, is when the decoupling starts. Like, so when things start to not unravel, but when gold starts to rally along with a rallying dollar, or the Russell starts to underperform the broader market again, or you continue to see this underlying strength in the VIX that we outlined yesterday on what was a pretty benign day yesterday. What is that telling you? All those things are in play. And that probably, Dan, leads us to a question that we got asked. If you want to throw that question up, because I think this is perfect for this day specifically. This is from Peter. I think that's how you pronounce it. You can read it. I'll read it. I was wondering if either can do a bit of focus on volatility. Selling vol continues to be a massive trade. Calls now priced over puts. You can read the rest of it. We've talked about this for a while. And, the reality is, people used to buy volatility to protect portfolios, to protect underlying positions. When people realized that the market doesn't go down and there was no reason to buy volatility, they said, well, I don't need that drain on my portfolio, on my performance, so I'm not going to stop doing that. So then they stopped. And then I think people came to the realization, well, wait a second, if the market doesn't go lower, I can sell volatility and add a synthetic dividend for myself. And I think in the world of passive investing, that's what that's created, a dampening of volatility. I don't think it's particularly healthy. And I do think the reasons why you see those huge spikes in volatility once, twice, 3 times a year is on the back of that. And maybe we're setting up for another type of that situation, Dan.
Yeah, and it's a great question, Peter. And last week, I think it was on Monday or Tuesday, we were talking about NVIDIA, which we do most days, but we highlighted the fact that you just pointed out, is that in some of these tech stocks, and specifically in the semi space, and we were looking at NVIDIA, we were looking at the 1 month out, $100 out of the money call, 1 month out, $100 out of the money put. The cost of the call was 50% more than the cost of the put. And and one of the reasons why I wanted to use the wings, as they call them in the option so far, it's just showing you how much speculation there is on the call side, when usually people are willing to pay up for way downside. You know what I mean? They're paying high vol prices in terms of puts just to have the peace of mind, so things kind of got out of whack, if you will. It is what it is. If you're long stocks and you don't want to sell them, and they've had big gains for whatever the reason is, at least if you're getting a little nervous about the market, if you're getting nervous about the macro, if you're getting nervous about individual stocks in events or valuations and so whatever, then you can always sell upside calls against it. Do something. Like we talk about that all the time. If you're starting to kind of get a little nervous about your positioning, whether it's the lack of diversification, or if you were long a stock like Nvidia heading into this year, okay, and it was under $500, and then all of a sudden it trades $725. It's become a much bigger part of your portfolio, especially if some of the other stocks that you own have gone down in price, right? So at some point, you have to start thinking about diversification and risk management. And one way to do that in an easy fashion is to sell some premium, sell some calls against it. All you've done is basically capped your upside at that short call price and the time in which the expiration is. But oftentimes, most out of the money calls and puts expire worthless. And that's why selling vol in most environments is a good strategy, definitely against long stocks. But we don't generally, and you'll never hear Guy and I generally talk about selling naked calls or puts. It's just not something that we think is that appropriate for most retail investors.
Agreed. That's something, percentages suggest it works close to 80% of the time. That's what the math suggests. What they don't tell you, though, is that 20% of the time it doesn't work. All those gains you've gotten on the 80%, you've given up and then some. So it's a dangerous thing to do, and we don't advocate it. But that's it for today, Dan. Again, coming off a great Ranger win, a Nick loss, which I think will be a galvanizing moment. Little snow out there, but the skies are clearing. So I'm heading into New York City. We'll be back tomorrow with the great EY from SoFi. Want to thank the folks for joining us, and we'll see you tomorrow.
See you tomorrow, everyone.